Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, well, there's really only one place to start. On Wednesday, April 2nd, President Trump announced one of the biggest changes in US economic policy in a generation, with the measures announced bringing the effective tariff rate on imports into the US to their highest level in at least 100 years. Markets have since been digesting the impact, with equities falling sharply, bonds and gold perhaps predictably rallying, and the US dollar depreciating against most other major currencies. So today we're going to consider the outlook from here, discuss the impact on economies and markets, and ponder, as ever, what smart investors should do. I'm delighted to say we're joined once again by Kurt Reiman of UBS on the US East Coast. And Kurt, given the nature of events and the pace of changes, I should start by pointing out that we're speaking on Friday morning where you are, Friday afternoon where I am, just in case, because things can get rapidly overtaken by events as we've seen. But Kurt, look, it's great to have you with us. And let's start a nice easy one for you. Give us a quick summary. What happened on what Trump called Liberation Day? Give us just your take on what happened. Sure. It was a pretty extraordinary day, wasn't it?
Yeah, it's great to be with you. Unfortunately, the circumstances bringing us together on this conversation are quite difficult. It's a rough period here. We're reacting to quite a bit of news coming through from the administration on tariffs, which were expected, but the announcement was far and away beyond most, including ours, view of what was likely. And if it's okay, maybe a little kind of a walk down memory lane, a little brief recollection of what happened during the first administration under Trump. Then President raised tariffs mostly on China, and the effective tariff rate, this is something that if you're not familiar with it, you will be soon, but that's just whatever the US brings in for income from tariffs divided by the imports, and that's your effective tariff rate. That was 1.5% back when President Trump took office in 2016. In 2018, when the trade war happened, and by the way, there was also a giant tax cut for companies and individuals in 2017 that gave a bit of a tailwind to the economy. But anyway, when those tariffs came in place, the effective tariff rate went from 1.5% to 3%. It came down a little bit during the Biden administration, even though the tariffs stayed the same and were even raised in some cases. And the reason for that is that the tariffs were imposed mostly on China, but those goods found other routes into the US where they had preferential trading relationships or lower tariffs. So since the inauguration, we've already seen a number of tariffs come into place in North America related to immigration and drug trafficking, also with respect to China. So a 20% percentage point increase in China's tariff rate, a 25% tariff on most U.S. imports from Canada and Mexico that don't fall under the USMCA trade agreement. Steel and aluminum tariffs, announced tariffs on cars and car parts. The effective tariff rate went from 2.5% already to 9%. So quite a bit more than what we saw under Trump 1.0. Yesterday, as you said, time is moving quickly. Wednesday's announcement raised the rate from our estimate of 9% to 25%. 9% was already the highest tariff rate that we've seen since the 1940s. 25% is something on the order of magnitude of what we saw during the 1930s. If you're a historian and you follow this stuff, the Smoot-Hawley tariffs, which many suggest brought the U.S. partly into the Great Depression. So this is very high. It could go higher still. Sort of depends on whether we have retaliation or more discussion and diplomacy and negotiation. But as it stands right now, this is well above what most expected. It's a 10% rate on everybody, and some countries were singled out. We can talk about that if you want, but with higher tariff rates, China at 34%, for example, the EU at 20%. Lots of exclusions. In a nutshell, this is something we haven't seen in almost 100 years. And it's an exceedingly aggressive stance, given the range of grievances that we've heard from the administration about trade.
Well, Kurt, let's get into it then. And you talked about the effective rate then. I've got to ask you then, what's the outlook? Because I guess the effective tariff rates could climb higher still. You've already alluded to the fact that we'll see retaliatory moves potentially from some, though not all countries who are subject to these tariffs. Do we think that the effective rate decreases? I don't know if we're looking 3 months, 6 months out. Just give us a sense of what the outlook is just in sort of pure tariff terms.
That's right. This is exactly the question we should be thinking about. What are the off ramps, and what's the chance that we don't get them and instead we go the other way towards escalation? There's a key piece of all of this that's been lost in some of the analysis that I've seen, but in the executive order, the administration excludes a lot of products from tariffs. Now, some of them are excluded because they're already tariffed elsewhere. So, think about steel and aluminum and the derivative products from steel and aluminum. Those tariffs are already in effect. Auto parts, tariffs, those came into effect. So those are excluded from these larger reciprocal tariffs. Pharma, semiconductors, copper, energy, rare earth products, lumber, these were all also excluded. If you're thinking about exporting from Switzerland, that's good news given the share of pharmaceuticals and overall exports to the US. It's also true for Ireland. If you're thinking about it from Taiwan or Malaysia's point of view, the exclusions on semiconductors was a bit of a stay of execution. But that's exactly what it is. The administration is likely to open up investigations under what's called Section 232, and that's just a trade remedy that is available to the president. But if you're going to follow that, you got to follow it through to its end result. There's investigations and hearings and opportunities for feedback, but these could see higher tariffs. So that'll add to the effective tariff rate. Our calculations are if you add in 20% tariff from before and the 10% effective tariff rate that existed before Trump took office, you're looking at a total effective tariff rate of something over 60% on Chinese goods coming into the US. So that's a bit the story about could we see this go from 25 to 30% all in? Could it go lower? And that's actually a very interesting discussion. You think about there's a domestic component and there's an international component. The domestic could be legal, could be congressional, and it could be political. By that, I mean, we've seen a number of executive orders enjoined by the courts. The statute or the legal remedy that the administration took under the International Emergency Economic Powers Act, it's never been used before. There's no legal precedent. It could very well be overstepping the executive branch's authority. We'll see. There's very likely to be court cases, maybe challenged. That could happen rather quickly. Congress, the Senate is already working on resolutions. There was one passed as he was making his announcement in the Rose Garden to end the tariffs on Canada. It's not going to go anywhere. The House is not going to take it up. But already you're seeing some political momentum in Congress. And it's important because as these bills come along, Republicans are going to be forced to vote in favor, effectively, of keeping these tariffs. That can come back and haunt them in 2026 with the midterm elections. And politically, Trump cares about his favorability ratings. And there's an economic impact, there's an inflation impact, there's a financial market impact. These are all happening quickly and in real time. That may matter in the negotiations. But then countries can also internationally, right? They can come in and they can make appeals. And we've seen that happen in a number of dimensions. So we should be thinking about that as bringing potentially the tariff rate down, maybe in an ideal case into that 10 to 15% range. But that's really kind of a best case outcome at this point.
Well, yeah, and Kurt, look, the numbers are still just so arresting. And as you said, we have to go back a century, really, to find any sort of equivalence. And you've already mentioned earlier what some people suggest that contributed to in broad brush economic terms. Just fairly briefly then, if we look at, the impact, and let's look at the US picture first of all, growth, inflation rates. You've mentioned these things already. And look, from this side of the pond, we look over and said, wow, Trump in January, he takes over. He's got an economy that's actually in pretty robust health, certainly if you look at the global picture, and he seems to be challenging it, be pushing it. Just give us a quick sense of what your take is, I don't know, growth-wise, inflation-wise, the stuff that's also going to then hit US consumers, in their pocketbooks, and probably quite quickly. What's the direction of travel as you see it?
Yeah, it is going to hit consumers very quickly. The tariffs go into effect very soon, should start to show up. How it shows up, there's whole different theories on this. One of the administration's theories was that the US dollar would strengthen. In fact, it's gone to a weaker stance, so that's not going to help. Might even make the inflation impact worse. There's this idea that other companies outside the US could eat it in their profit margin. These are pretty high tariff rates that might force some companies to go out of business when we look at some of these numbers that have come through. In the US, yeah, companies could pass it along. And there is this idea that we've just been through a round of inflation, so maybe consumers are more primed to accept price increases than they would have been, say, before the pandemic. So, yeah, we do expect that if we get even some relaxation of these tariffs, which seems reasonable over the next 3 to 6 months, this would shave off substantially our economic growth forecast, which was already pretty conservative for the year. We were at 3% roughly in 2024. We had it at 2%. Now, our base case is that we will see a growth rate of less than 1%, and it could involve an inter-year, couple quarters recession with a GDP decline of 1% from peak to trough. So that's a pretty big hit to the economy relative to what we thought when the administration took office in January. And the data was already weakening. I don't think we should attribute this all to tariffs. If you think about it, if you're a government worker and you're worried about your job, maybe you're not going out and redecorating your home. If you're an undocumented immigrant, you might be thinking about not going out to eat. If you're a company and you're thinking about a lot of the changes, you might be frozen on CapEx. And we've already heard from a number of countries that they're boycotting US goods. Canada stands out. So we should expect weaker growth and at least temporarily higher inflation. This is a one-time, it's like a tax increase, so it's a one-time shock. Might be the biggest tax increase, by the way, since the 90s or even before that. This is something that we don't really have modern day or in this recent generation of an experience. So we should expect around a 2 percentage point increase in consumer prices by the end of this year. And that assumes only a partial pass through, that it's a full on download to consumers. That is a very difficult environment for the Fed when you're thinking about the mix. It's a stagflationary type of environment, weaker growth and inflation moving higher. We think that the Fed would, in this case, see the risks to growth as more important. It's got to get some signals here first, like claims for unemployment insurance. Those haven't gone anywhere. They've been very low. The unemployment rate is still just barely over 4%. We've got to get some of the data before the Fed's going to take action, indicating that the economy is weaker, because otherwise this is just a stickier, higher inflation world. But it seems reasonable that they would be thinking about rate cuts of somewhere on the order of 0.75% to a full percentage point over the course of this year.
Yeah, now, Kurt, let's just talk quickly about markets. You've made some allusions already, and obviously the picture for US equities has been, well, I don't want to say predictable, but it was certainly within the realm of imagined consequences. What about elsewhere? The bonds picture, currencies, you've already mentioned, the dollar is tracking down. Some thought it might help. Commodities-wise, what should we be looking out for in terms of useful, gaugeable, sort of then for investors to actionable market moves, and over what kind of time period?
Coming into this, as you say, some of this was, the foreshadowing was there. It's not a surprise that tariffs happen, but the degree of the tariffs is really the magnitude of them is what was surprising. So we had been cautioning around this volatility and advising of hedging some of the equity exposures, diversifying portfolios, incorporating gold and other assets that might smooth the ride. But clearly, the announcements has surprised us and the market more broadly. So we're now in a mode of thinking about, beyond this initial impact, the outlook for the stock market. It does appear that the upside case for equities is lower. That our December 25 target at the start of this year was 6,600. We had reduced it to 6,400. Again, that's for the S&P 500. And now our target has been reduced further to 5,800. And that's largely a function of earnings, which is now down from 275 at the beginning of the year to 250. So that means that, as the market is opening today and we look at the S&P 500, trending, ever closer to 5,000, that does mean that that's an upside scenario, but it does involve some weakness year to date. We would also be taking the longer view here, thinking about some of the opportunities, if you will, that exist that are structural and that might be less affected by the tariffs because of the strategic nature of the investment. We have seen technology hit harder than the broader market. It's also been true for small caps. That tends to happen in both directions, up and down. But we don't think that the AI investment thesis has been derailed here. We think it's intact. It's a core part of companies' business spending. When I talked about that, maybe companies are freezing their capex here with the uncertainty. One thing they're not likely to stall is investments in productivity, and right now AI is at the center of that. We have taken down our rating on the AI theme and technology from most attractive to attractive, but we still like it. And that's true also for power and resources and this other theme that we recently introduced on longevity. So those are some ideas. Also thinking about, protecting the downside, that's always relevant. And in some cases, thinking about the benefits of holding a diversified portfolio here, I think that resonates. It was already starting the year as a relevant way to invest. A bit of a sea change from where things have been, but nonetheless, having incremental exposure to international markets and having a diverse portfolio incorporating gold, which has done very well, likely to continue to do well in our view, is just another shock absorber that can help get us through this period of time.
Yeah, Kurt, look, super interesting, and I could chat to you all day. Just one thing I wanted to ask you about quickly is that everything you've said, it's these caveats, aren't they? The volatility. Trump is he's politically potentially volatile. He's personally volatile. He changes his mind. How do we consider even potential alternative scenarios in this space? Because I guess, look, you and your colleagues have to do that, right? And clients will say, yeah, but what if? How do we look constructively at those potential alternatives? What do they look like? What do we need to have in mind? And I know some of these are probably, if not vainglorious, they might be somewhat unlikely, but I guess you still got to game those scenarios, right? And
Sure.
at least keep them in mind.
That's right. Coming into the tariff announcement, we said there's a wide range of potential outcomes. I think people had their base case, but it wasn't a high conviction base case. And we always, even when there's not this kind of volatility, we're always thinking in probabilistic terms around scenarios outside of our base case, an upside and a downside. That 5,800 S&P 500 target is our base case. It's a tariff-led slowdown. We only assign a 50% probability to that. That means there's very high probabilities for the upside and the downside. They're not the highest, but otherwise they'd be our base case. But if you think about the S&P 500, yeah, in a hard landing scenario, maybe we'd be talking about 4,500 on the S&P instead of 5,800. But we could be turning towards a world where, rather surprisingly, the tariffs are removed quickly. You get a resolution of the trade disputes. You still have the impact from the earnings on AI, and the worries about growth, were unfounded. And then you're back to our target roughly on the S&P 500 where we started the year. And that bull case, if you will, that's a positive surprise, would be a 20% probability. So we're not ruling it out. Again, even legal recourse that we could see coming through the court systems might involve a rather sudden reversal of these tariffs. The administration would probably go and pursue the tariffs through other means, but I think by definition, they'd have to be much more selective in the countries that are targeted, and the products would be at a delay, significant cost and timing. So getting back to that 10% effective tariff rate roughly is not unthinkable. And it's these kinds of reasons that we advocate staying invested, staying diversified, incorporating potential hedges. I think about bonds these days, the value in fixed income. When you think about some of the periods that we've lived through recently where there was volatility, whether it was the first round of trade tensions or before that, even the Euro crisis, or after that during the pandemic, bonds hardly had any income because we were at the zero line or lower in some cases for monetary policy. And today you do have income, and that provides ballast. And clients have been migrating to fixed income. It's been a source of positive return this year. It's been income, and yields have fallen. So there are still ways to manage through this. And to your point, exactly, we have to be thinking about other scenarios beyond just our base case, because, the ability to predict here is only the ability to see the signal from the noise. And there's a lot of noise right now.
Kurt Reiman, thank you very much. And that brings us to the end of this edition of the Bulletin with UBS here on Monocle Radio. Listen again and explore more at monocle.com. Join the club and subscribe to Monocle magazine while you're there. You can discover more and find out how UBS can help you, as ever, at ubs.com. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.